Welcome back to another live stream. I'm Zach. This is Wolves in Finance. I'm a certified public accountant, and I'm here to hang out with you and answer your questions. We're here today to talk about Silicon Valley Bank, their collapse yesterday, and what that means for you and the future. This is a little bit more laid back than I normally do. Those of you who watch my channel, I put out about a 10-minute video every week on a business topic. But the events of yesterday were so big that I felt it warranted just doing a live stream. This is all breaking news. So, we can just talk through everything we know that has happened so far. I can chat with you guys in the chat and talk about what my opinion is on what's going to happen in the future. I just thought this was I've done a couple of live streams in the past, and when something big is happening, and this is something big that I thought warranted a live stream. If you guys like live streams, you want to see me do more live streams, let me know in the chat. And if you have any questions, just let me know in the chat. I'll try to get to all of them that I can today during the stream. We already got Stephen Mortimer in the chat saying, buy the dip. Hey, Stephen, welcome to the stream. Okay, so I don't have this like really strongly structured. I kind of just wanted to talk through some of the different points. Oh, before we jump into all the banking stuff, though, just to give you a little update. So there was no video last week. I've been sick. I've been sick for the last week with one of the worst colds of my life. I had the stomach flu, and I don't know if any of you guys have ever had the stomach flu like this before. I don't want to get into all the disgusting details, but there was a lot of throwing up. And have you ever had a cold when you had so much stuff coming out of you that you looked at it and you're like, it's not physically possible for this much stuff to come out of me. Like, I didn't eat this much. I didn't drink this much. Where is all of this coming from? Have you ever experienced a cold like that? Because that was the cold that I had last week. Now, luckily, I'm feeling better, but it's taken like a week. And man, it was rough. That was one of the worst colds I've ever had. But I'm here. I have a bottle of Gatorade I'm drinking, trying to stay hydrated. And my original plan was I need to take another week off just to recover, to get my strength back. But I was like, I can't. I have to come on and talk about this banking story because it's that important. So where should we start? I think we should probably just start by talking about what happened. What happened? Let me close this down. So Silicon Valley Bank, it failed on Friday. This is the second largest banking failure in U.S. history. So if we let me bring up the Wikipedia list. Now, you can't, whenever you use data from Wikipedia, you should always verify that data because Wikipedia is not 100% accurate all the time. But usually with lists and stuff, they're pretty good. So here's a list of the largest U.S. bank failures. And you can see Washington Mutual in 2008 was the biggest bank failure in U.S. history. Number 2 now is Silicon Valley Bank at $209 billion yesterday, 2023. So this is a pretty big deal that happened yesterday. And one of the craziest things is people didn't really see this coming. People in general weren't expecting this. So it's $209 billion is a pretty big bank. So for such a big bank to go under and no one was expecting it, and it all happened within 24 hours, that's something that if you're in the financial world and you have funds that you're managing, or just if you're an average person, this is the type of thing that you should pay attention to. And there's going to be ripple effects to this that we're going to talk about by the end of this stream. Let me get some more of these chats. Hello, I see a bunch more people in chat. Hair Director is in chat saying, yep, I had it for a month in a row. My kids had it too. Or he's talking about the cold. Yeah, I hope you guys have all recovered. It was really hard for me to deal with it. Callie says it's going around, lots of stomach flu. Sneer is in chat saying hello. Hey, welcome to the stream. Hair Director says, just purchased a new home in the Netherlands. Am I in trouble too? ? We also had a housing crisis after Lehman Brothers. The Netherlands, that reminds me of something. I posted on Twitter this week. Hold on, let me just pull up my Twitter account. You can join my Twitter. It's Wolves in Finance. This is the webpage right here. But I actually post on here quite a lot. So this is a good place to follow what I'm talking about on this channel, as well as other important business news stories. Here's our live stream right now. This is SVB. But this news story I posted about on March 5th, Blackstone defaults on Nordic mortgage-backed bond. So this was Blackstone, which is a huge investment bank in the United States, had mortgage-backed securities, and I believe this was in Finland. So I know that's not the same thing as the Netherlands, but it's close. It's in that area of Europe. But yeah, this stuff is interconnected. There's defaults happening funded by US banks in Europe, European housing projects. Just other things to pay attention to. Welcome to the stream. Anyway, what was I talking about here? Yeah, so this is one bank that went under, Silicon Valley Bank. But I think something to keep in mind is that there's a systemic thing going on, and it's really interesting timing that this all happened, because my last video on my channel was on the Federal Reserve. And if any of you guys have missed that video, it was posted 2 weeks ago. Go check it out. I talked about the problem with the Federal Reserve doing quantitative easing and quantitative tightening. And let me pull this up, because it's all related. It's all related. So SVB collapsing, yeah, SVB probably did some shady stuff here, which is why they collapsed. But they're not the only ones to blame. The person who really caused this collapse is the Federal Reserve doing quantitative easing for 10 years. That's the real problem here that I think a lot of people are missing in this story. So, and this is what I talked about in this video. This is the chart of the federal funds rate from, the 50s to today. And it's all, it bounces up and down. And you always hear the news stories about the Fed is raising rates or the Fed is lowering rates. But what you have to notice here when you're looking at this chart is that the last 10 years, pretty much, we had these really extended periods, these very bizarre periods of 0% interest rates. This was very bizarre. And so banks like SVB are loaded up in all their portfolios are all loaded up with these 0% rate loans. And you can see here, the Fed funds rate shot up to 5%. And it's going higher, by the way. The Fed has announced they expect to continue to raise rates in the future. So this is only going higher. And so they're trying to figure out, as a bank, all banks are trying to do this. They're looking at all their portfolios and all these, and then they're trying to suddenly convert all these 0% rate debt into 5% rate debt. And this bank ran into problems. And I think there's a lot of other banks that are probably struggling with the same things. Now, this bank is unique, and so they're a little bit more susceptible to this problem than other banks, which we will talk about. But this is like a global problem caused by the Federal Reserve and this 10 years of 0% rate loans. And now everyone is trying to switch all at the same time. This is very similar to the crisis that happened recently in England. Did you hear about the where the English pension system almost collapsed? It's the same kind of deal. Interest rates are suddenly rising. They're trying to restructure everything, and they're running out of money in that process. So that's you have to keep in mind that this is one specific bank, one specific instance, but there is this larger systemic thing that's going on, and it's driven by this sudden change with the Federal Reserve rates. Sneer in chat says, do you think traditional money will disappear shortly? That's a good question. That sounds a little bit like a doomsdayer question, and I'll talk a little bit about that today. But in general, I tend to not see huge changes like that coming, at least in the near future. Things like, our entire currency system is going to collapse. They're going to get rid of all of our money and replace it with new digital currency and that kind of thing. I think what's more likely is there's going to be a recession and a market crash. I think that's a much more realistic prediction of what's going to happen in the future. And when you start to get into these doomsday scenarios about the entire monetary system changing, it's just less likely. It's more likely that we're looking at an upcoming recession. Now, and even a recession, I mean, that's just my opinion. I mean, you can just take my opinion for what it is. As of last week, I was still watching interviews on business news shows of people saying, hey, the economy is fine. Unemployment is relatively low historically. I am investing in the stock market. That's what other people are saying. That they're confident that everything in the market is going up from here and that people shouldn't be worried. There's a group of people who believe that. There's also a group of people who are bearish, who think the market is about to tank. I'm more in the bearish camp, and I think that we're looking forward to some economic hurt. Just my opinion. So what's happening to people? What's going to happen to your money if you invested in this bank? I think it's just important to say up front, people will get their money back up to the insured amount of $250,000 if their savings was insured by FDIC, which is the Federal Deposit Insurance Corporation. Here in the United States, that is kind of our safety net, that if you have your money in a U.S. bank, that is federally insured. That is the insurance limit where $250,000, you can be confident you're going to get your money back. And just to kind of emphasize that point, let me just pull up something I read. This is from a Forbes article, I believe, from yesterday. Let me make this bigger. All right. In a press release, the California Department of Financial Protection and Innovation, now the California Department of Financial Protection and Innovation, that's the local state agency that is going to implement the FDIC insurance. So, all banks are managed by their local jurisdiction. So this is a California bank. This is the California agency that has taken over the bank and is going to implement the FDIC protocols. Okay, so this entity said that insured depositors will have full access to their insured deposits no later than Monday morning, March 13th, 2023. Uninsured depositors and more than 93% of the bank's $161 billion in deposits were uninsured. They were told they would get a receivership certificate for their remaining funds to be paid out in future dividend payments as the FDIC sold off SVB's assets. Okay, so if you banked at SVB Bank, what you're experiencing right now is you log into your bank account online and you get a screen that says you're locked out of your account. Okay, so you have no access to your money right now. This press release is saying they're going to work on this over the weekend, and come Monday, you should be able to log into your bank account, and you will click on your bank account, and it will pop up and says you have a balance of $250,000. If you had more than that, if you had less than that, you'll have whatever the less amount is. So they're promising that's going to happen by Monday. Can you imagine if this happened to you? Could you imagine like logging into your bank account one day and getting this screen and you not being able to access your money? Oh my gosh, I would be furious. But this is the really shocking part of it here. If you have more money than that, more money than $250,000, which is 93% of what's in there, you're going to get this. You're going to get a certificate. This is going to be an IOU. They're going to hand you this piece of paper with IOU written on it, and you may or may not get your money back. You know, I'm not laughing at the situation. I'm just laughing at how shockingly horrible it is. So you may or may not get your money back. And what this entity is going to do, this entity is going to put this bank into bankruptcy, which might last 2 years. And they're going to slowly sell off the assets. And then you are going to get your proportional share of whatever the assets might be, whether that's 80 cents on the dollar or 75 cents on the dollar. So if they recover 75 cents on the dollar and you had $1 million in there uninsured, that means that you're going to get $750,000 back and you're going to just lose $250,000. So it's really kind of shocking. And especially because people weren't expecting this. A lot of these people did nothing wrong. They just woke up one day and all of their money in this bank is frozen. It's pretty shocking stuff. What else are people saying in chat? Oh, Liam's having fun is in chat. Hey, Liam, how's it going? Welcome to the stream. Jay Wagon says, how big do you think the ripple effect will be on all of tech and startups who did much or all of their financial activity with SVB? Now, I'm going to get into the ripple effect in detail in a little bit, so stay tuned. We're going to get there. Hair Director says, 100,000 euro insured here in Europe per bank group. Can imagine that. We remember I think he's referencing another debacle in the past. Callie says, yes, the Fed's going to print more to cover the insurance. Jay Wagon says, do you think the Fed might have to consider QE as an option? Good question. I think the Fed is very limited in what they can do. The Fed is fighting inflation right now. If they do more QE, they're going to cause more inflation. So I don't think they can do QE. I think the Fed is out of options to really help here. So I have some thoughts on what might happen, but I'm going to get there. I'm going to talk about my opinion on the future at the end of this live stream. So that is coming in the future. Hold on. I need to take a drink of my Gatorade here. All right. All right, I wanted to talk about just for a second on what is a bank run because I realize that not everybody really knows what it is. Um, I know most of you probably do, but some people might not, you know. So the most famous example of this is, we've all seen the movie It's a Wonderful Life. That's probably everybody's best understanding of what a bank run is. And they show it pretty well in that movie where um, the main character here is running a savings and loan bank, and there is some concern that there isn't enough money in the bank, and then everybody rushes to the bank at the same time and tries to withdraw their savings, and there isn't enough money to pay everybody out. And so what you see in the movie is he sits there and convinces everybody to just withdraw enough to survive for the moment and keep the bank running for a short amount of time. But if people don't agree to go along with that and everyone says, just give me your money, well, at some point the bank is going to collapse. And this is what a lot of people don't realize is that no bank has everybody's money. It's not like everybody's money is sitting in the vault in the back. The point of a bank is to take in money and then lend it out again because that's how the bank makes money. So any bank could potentially collapse. Like no bank just has everybody's deposits in the back. And, that's why we have FDIC insurance, which means that everybody has at least a little bit of insurance. But this could happen to anybody. Now, most banks have, good reserves. They have risk management procedures. Usually this wouldn't happen to every bank all at once around the country all at the same time because we need banks. I mean, if you pull money out of one bank, you're going to put it in another bank somewhere else. So there's going to be banks out there, but from time to time, one bank or another across the country might lose confidence for whatever reason. And if people don't have confidence in a bank that it's being run effectively, that maybe they're doing something fraudulently or whatever, people start withdrawing from the bank goes bankrupt. When the bank goes bankrupt, you might not get your money back if it's above the federally insured amount. So there's no guarantee when you put your money into a bank that you're going to get it back. And that's just something you have to keep in mind that, it's a smart practice if you have a lot of money to have multiple bank accounts with different banks so that if something happens to one, then you can still operate with your funds in another one while everything gets sorted out over here. Now, the people in SVB, they're not going to lose all of their money, but they might lose a little bit of it. The real problem is people who only have one banking account at SVB, their money is locked up for like 2 years. So, it's not like they can give them a little bit to get by. Like they're in bankruptcy proceedings unless something changes, which I don't think anything's going to change. Your money is locked up until that gets sorted out because the money has to be distributed fairly to everybody. So the problem isn't you getting most of your money back. I think people will get most of their money back, but it'll be 2 years from now. And who can survive with no money for 2 years? Well, you won't have no money. You'll have the point of the insurance is that you'll have $250,000. But if you're a business, for instance, you're going to need a lot more than $250,000 to survive. So, it's a really, really difficult situation. But the point is, I just wanted to, make sure that people understand that bank runs are still possible. They're still a thing. And it's something to be prepared for. It should be aware and be prepared for. And this is one of the largest banking runs we've seen. Well, it's been the biggest one we've seen since 2008. So, I mean, they're not that common. In fact, let me see if I can find. I was looking on Twitter. Someone posted the video of people waiting in line in front of SVB, and it's just heartbreaking to watch. Oh, here it is. Here it is. These are people waiting in line on Friday outside of SVB. This is a bank run in real life. This is what it looks like. And these people are waiting in line to get their money, and they're not going to be able to pull their money out. And it's so heartbreaking. I mean, I can barely watch this. I can't even imagine what these people are feeling right now. I mean, yeah, I mean, can you imagine that situation? Like waking, these people had no idea. They just woke up to today or on Friday and couldn't access their bank account. I mean, it's shocking. So hopefully the insurance thing gets set up by Monday so that Monday they can access and at least pull out enough of their money to buy groceries or whatever it is that they need. But yeah, it happened back in the day, and it still happens today. All right, let me catch up on some of these questions. Amin in chat, oh, welcome to the stream, says even Fed options are limited. Liam in chat says Gatorade, not Perrier. Yeah, no, I'm not drinking Perrier today. Liam says, I think the Fed should not have rose the rates. Liam says, FDIC was one of the protections for consumers as a result of the 1929 crash, and it is a good practice to not put more than the FDIC insured amount in one account. Yeah, yeah, I mean, I agree with that. I agree with that. That's kind of what I'm saying is that, if you have more than the insured amount, it's a good idea to have multiple amounts in different banks. Now, what becomes tough is if you're a company. I mean, if you're a company and you have millions of dollars, you can't spread millions of dollars across, 20 banks and effectively run your company. You need a few different banks. But the people who are just really in trouble right now are those companies that have millions of dollars to run their company in working cash, and they only had one bank, SVB. And I know that there's companies like that out there. Those guys are in serious trouble right now, and they're trying to figure out what to do. I mean, everybody in the finance industry is working all weekend, and they're not sleeping this weekend. Everyone on Wall Street, people in banking, they are working all weekend trying to figure out what is going on. So let's talk a little bit more about what was SVB, because SVB is not a normal bank. Let me get up my SVB sign. Yeah, SVB was not a normal bank. SVB was a really niche bank targeted towards startup businesses in Silicon Valley. So it was a regional bank. It was, focused on tech companies. So most of the money that's in there is not like normal people money, like you or me, getting our food budget or our paychecks or whatever. Most of it was company money. Companies have treasury funds, reserve funds, working capital funds. This was their bank that they all used. So it's a little bit different. It's not like it's not like a normal bank. It's not like a normal regional bank. It's very kind of unique to that situation. And for that reason, it made the current environment of everything that's going on more destructive for their situation, because Silicon Valley is under a lot of pressure right now. A lot of these businesses are having to pull money out to keep their operations going, just in general, let alone now they're pulling money out because they're unsure about what's going on with the bank. just to show you how big this bank, what a big deal this is, I have a screenshot here. This was, I guess this is off of some material from the bank or something. Somebody posted this on Twitter and I screenshotted it. It says 44% of U.S. venture-backed technology and healthcare IPOs year-to-date bank with SVB. And this is based on some pitch book, probably from the bank. But regardless, what this is saying is that if you had gone public as a startup in the last year, almost half of them banked with this bank. So this is just saying that this is a huge chunk of the startup industry in the US banked with these guys. So they're a pretty big deal. What you should think, that's hard to kind of wrap your head around what that means. Think of it in terms of this. You hear about all these like crypto coins, all these crypto coins and these crypto companies and these crypto banks. That's what we're talking about here. They all had, they need reserve funds to back their crypto coins. Their reserve funds might have been in an account at this bank. And now those reserve coins are frozen for the next 2 years. So what is happening to that crypto coin? There's a lot of stuff like that that's going to happen just because of the unique nature of this bank. That wouldn't be happening with other banks if other banks went through this. So this is a very kind of unique situation that's just unique to this bank. Something else that I found very interesting, I found this on the Wikipedia page and I did not know this. This is the Wikipedia for Silicon Valley Bank. This is saying, and again, I can't verify if this is accurate or not. It's saying SVB was the 16th largest bank in the United States at the time of failure and the biggest in Silicon Valley based on local deposits, with a 25.9% market share as of June 30th, 2016. So a quarter market share? Like that is huge. So that means like Silicon Valley with this, it's so hard to wrap your head around what is going on. A quarter of the deposits in Silicon Valley are locked up for the next 2 years during this bankruptcy process. Holy cow. Holy cow. That's just, giving you an idea of the impact of this situation. Liam in chat says, just minimize the losses. Amin in chat says, people were not aware of the bank situation before it collapsed, ? They should have read or seen or heard some bad news as collapsing doesn't happen abruptly, ? It's interesting. I mean, I think it took most people by surprise. I think there were probably people, it sounds like there were people in the know, like risk management type people or people who are like really close to what was happening in that bank who knew. I mean, obviously there were venture capitalists who got word of this and started the run by pulling their money out. Something that's been of note that has been talked about lately is that Peter Thiel, who's this big venture capitalist, allegedly started this by, telling all of his companies to pull their money out. So I think that's a little far-fetched to blame this on Peter Thiel. And I think people are blaming him because he's a well-known Republican and they're trying to make this political. I think it's more likely that this isn't politically motivated. This is like a bank going under. I think the problem is not Peter Thiel. I think the problem is this bank. So anyway, to get to your point, it is unusual that it happened so fast for a bank this big to go down so fast and to have nobody know about it. That does seem to be pretty much the case, though. I mean, there's a small group of people who got some idea of it, maybe a week ago. But even then, that's really fast. And it makes you wonder if there was some kind of fraud involved, if maybe there was some misrepresentations involved. We don't know about any of that, but there could have been. There could have been some just incompetence. There could have been with managing their portfolio. Maybe they were just incompetent and they couldn't keep it together. But usually an unraveling of a bank this large develops over time, and there should have been disclosures made, and it seems like maybe there weren't because nobody knew about this. So it is an interesting situation. I believe that there's probably things that we don't know about. To your point, it is unusual. It happens so fast. I think that there's things we probably don't know about and may never know about. Liam says, how likely it is for Bank of America, Wells Fargo, or Chase to do the same thing? Oh, interesting. Amine says, excuse me, Zach, but you are supposed to follow up your bank news updates as you are concerned whether you like or not. I don't understand your wording there. So Liam asked the question about whether this will happen to the bigger banks. I'm going to save that for the end, Liam. I'm going to talk about what I think is going to happen in the future. So I'm going to save that question for a moment. But good question. We are going to talk about that. What I want to talk about now is, can SVB be saved? So there is still some talk on Twitter that SVB could be saved with some kind of bailout or something. Now, let me just tell you my opinion. SVB is beyond saving at this point. For SVB to be saved at this point, some investor would have to come in and say, I'm going to buy the bank for pennies on the dollar and put up everybody's money. SVB won't have any customers ever again. After what happened on Friday, they have lost all confidence from any future customers. So what customer is going to stay banking in the bank in the future? Nobody. I wouldn't. Would you? So with that scenario, no business person I know would buy a business with no future customers. Why would a business person do that? So I just don't see any scenario where somebody's going to come in and buy out this bank and save the bank. I just don't see it happening. People are talking about that. That's still a possibility of somehow working out over the weekend. People are talking about a possible bailout. That's not, I don't see how that's possible over the weekend. And if it doesn't happen over the weekend, it's over. So I think you have to assume that this bank is done. It's after Friday, it's collapsed. That's not the question that you should be focused on. What every finance person on Wall Street is doing right now, over the weekend, is they are looking to find what is the next bank. They're trying to find out is there another SVB out there? Like, we didn't see this one coming. Who else is out there that is similar to SVB that could be next? So I think that there's going to be a lot of pressure on a lot of other banks starting Monday on what their situation is. And like what we talked about at the beginning of this stream, this is part of this economic situation that is going on the macro level. So every bank is dealing with the same kind of pressures that Silicon Bank was dealing with in terms of rising interest rates. So, every bank is shuffling their portfolios around and dealing with that. And so, and everyone is going to be scared that they will be targeted as the next bank. And what you have to worry about in the banking industry is losing confidence. People just need to not lose confidence. Amin says in chat, also, are banks compelled to audit their financial statements? That's what SOX was created for. You are correct. They are compelled. They do need to do independent audits, and that's and SOX is supposed to mandate that. Armand says the probability of fraud occurring is low. Yeah, so fraud is not supposed to occur. But it always does, doesn't it? You know, there's laws in place saying do not commit fraud, but it always seems to happen. So I don't know if there was fraud in this situation. I don't know about that. But you can't rule it out. Liam says the federal government should save the banks since it was due to the Fed's rates going up, so Congress should bail them out. It's probably not going to happen. I think the assets will be sold to a larger bank that can take on the liabilities. All right, so let's move on to the question then. What happens next? I think this is everybody's big question, and this is going to be a lot of my opinion, so take this with a grain of salt. I'm just a YouTuber, okay? I am an accountant, but I am just a YouTuber. This is my opinion on where I think this is going to happen. I think I've kind of made the case so far in the stream today that what a big deal this is. This is a really huge impact, and I think there will be ripple effects. And so the question is, what will the ripple effects be, and who will they affect? And you know, one of the unique things of this situation is that it is so unique in that it's centralized around the tech industry. I don't think we're exactly sure what the ripple effects will be, but I think we can kind of surmise a couple of things. So I came up with this chart here. Let me see if I can make this bigger. And I just threw this together. These are just some thoughts here. But if you look at possible SVB ripple effects, now there's going to be a lot of different effects, but these are just a few that I think are some big important ones. You have SVB here. Here's the bank. We know that most of this bank's clients are startups, these tech startups. Tech startups are funded primarily through venture capital. Venture capital comes primarily from investment banks. Now, investment banks are normally protected by credit default swaps. And credit default swaps make everything in investment banks secure enough. This is like the insurance for investment banks, pretty much. So it makes investment banks secure enough that there are a safe place to park all of our pension funds, which are, you know, pensions or retirements or 401ks or whatever. So all the way at the end of this ripple effect is the ordinary US American citizen who has a savings account, a retirement fund, and we all know the baby boomers, the largest demographic in the United States, has recently retired and is now fully dependent on this pot of money as their retirement funds. So the point of this chart is there is a direct line of potential ripple effects from the default of SVB all the way down to people's retirement funds. Now the question is, will the ripple effect actually go this far, and will you see any impact down at the other end? That's kind of the big question here. And so let's kind of just like talk through this. So this is the big thing right here that everyone's talking about right now, SVB and startups. So if you have a startup and let's say you have millions of dollars of cash to run your business. Let's say you're a multi-million-dollar internet-based business that had your main banking at SVB. So that means your payroll runs through there, your working capital money that you use to buy inventory runs through there. You have reserve funds that are sitting in there. All that's frozen for like 2 years while they go through bankruptcy. So what startup can survive for 2 years? Very few. What most startups would do in that situation says, I'm just shutting my doors. I'm going to start a new startup with new venture capital somewhere else. So these startups, you're going to see some startups just go bankrupt just because they have no access to their money. And they have to wait for 2 years to get access to their money. So this is going to be a big problem, I think. So SVB is going bankrupt. I think you're going to see at least a chunk of these guys go bankrupt. If a chunk of these guys go bankrupt, then that's going to hurt some of these guys. Okay? They're going to see a huge portion of their portfolio suddenly be worthless. So these guys are going to lose money. When these guys lose money, these guys lose money. Okay, so you can start to see the ripple effect bouncing down through the economy. This is the real question mark here, credit default swaps. So this is something you also have to know about investment banks. Investment banks, they expect to lose money every year. They expect a certain amount of these guys to go bankrupt. They plan for it in their books. So these guys say, okay, I'm going to give so much money to set aside so much money to venture capital. Then these guys say, I'm going to put so much money in startups, and I'm going to assume 10% of them are going to go bankrupt. Okay, these guys are assuming 10% of them are going to go bankrupt. They assume that they're not going to get some of their money back, but they're doing that because they think they're going to make so much money with the people who survive that it's going to make up for those losses. So that is all baked into the system. Credit default swaps are there as insurance so that if any of their things, if that 10% fails, they get a little kickback from their credit default swaps. It's like insurance. So this pays out if they don't get their money, so that these guys will be okay. The problem happens is if more people go bankrupt than they were expecting. If more people go bankrupt than they were expecting, then these start to fail. They won't have enough insurance to cover all of their losses. And that's the point when these things start getting into trouble, because everything gets out of whack. That's when you start seeing things that used to be AAA securities weren't actually AAA because more things went bankrupt than they were expecting. So that's kind of the ripple effect chain that you should be watching for. There's also talk about the other potential ripple effects could be other banks that this could happen to. I am less worried about that and more worried about this. I think SVB was in kind of a unique banking situation. But these startups going bankrupt is going to be a huge problem. I don't see what happened to SVB necessarily happening to a lot of other banks, but it could. There were problems, also on Friday, there were also problems with Wells Fargo. Wells Fargo was having like a technical issue that might have been related to this. It depends on if they had some startup managing some of their direct deposit technology, but people who banked with Wells Fargo on Friday were seeing their direct deposit checks being deposited into their account and then being withdrawn again by Wells Fargo. So people's money was disappearing from their accounts. And I think it was just a technical glitch, but that is really bad timing to have a technical glitch, because what could happen is there could be absolutely nothing wrong with Wells Fargo, but people could see this weird stuff going on and start withdrawing all of their money, and Wells Fargo could suddenly have a problem. So that's the kind of contagion and fear that we have to start worrying about, is that somebody might see another bank getting into some kind of issue and then freaking out for no reason whatsoever and start withdrawing their money and transferring it to different banks and that kind of thing. So yeah, I'm not putting aside that this couldn't happen to other banks. It very easily could. But this is the big concern in my mind. Let's go back to 2008. 2008, Lehman Brothers collapsed. Lehman Brothers was here. Lehman Brothers was at this point in the ripple effect. Okay, they were one of the biggest investment banks in the world. Nobody thought Lehman could go under. And it did. A lot of people lost a lot of money. I think we could see another Lehman Brothers event. I think there are probably big investment banks out there that might be in a shady situation that we don't know about. Nobody knew about Lehman's situation. There could be another bank out there. Let me just give you an example, and I've talked about this on the channel before. BlackRock. So BlackRock holds most people's pension funds, and BlackRock has had I don't know if you've heard about the whole ESG scandal, but everyone is upset about ESG. And so people have been pulling billions of dollars out of BlackRock. You've been hearing about all of these states in the United States passing regulations that forbid state treasurers to put pension funds into BlackRock. Well, that means they have to immediately withdraw all the funds from BlackRock. And over the last year, BlackRock has had billions of dollars withdrawn from it. So BlackRock is sitting here as an investment bank already under pressure. They're already under pressure. And so now they're going to have to deal with this on top of it. That's where you start getting things happening. Now, I don't know if I'm not alleging anything with BlackRock, but I'm just saying, what happened in 2008 with Lehman Brothers, you could see something similar to that happen again with a large investment bank failure as a ripple effect from SVB. That's kind of the real fear, because that leads all the way to your pension fund. What else are you guys saying in chat? Amin says, citizen haven't either the knowledge or expertise to require redirecting the investments of their pensions toward a specific type of portfolio. They're more reluctant to invest as you. Liam says, it could affect the stocks of those companies if they were a publicly traded company. Amin says, I know reluctance is against investment. J-Wagon says, Moody's had SVB rated at A1 going into Friday, further proving this came as quite a shock to many analysts and individuals. Yeah, isn't that crazy how this could have such a great rating and then be bankrupt the next day? That's kind of wild. That is pretty wild. Liam says, what happened to too big to fail? Too big to fail is still kind of a thing. SVB wasn't a too big to fail bank, but I believe there are still banks categorized as too big to fail. I don't know the details on that. But there would be a point if, let's say, a bunch of smaller banks started to fail, there would be a point where there would be there would be a number of banks that would be assessed as too big to fail and protection put around those banks while other banks were let to fail. That's usually what happens when markets start to collapse. J-Wagon says, is the core issue the quickly rising short-term rates causing havoc on the investment portfolio of the bank's balance sheets? Yes. Amin says, ratings are not always reliable. You can say that again. Okay, so let me talk about let me talk about bailouts. Okay, what's the deal with bailouts? Because there were some important things that have come out, specifically Andrew Yang. We have a tweet from Andrew Yang. And I'm assuming you guys all know who he is. Former presidential candidate. He's from Silicon Valley. He is, I think he's a former tech entrepreneur himself. So he put out this tweet saying, I think either California or the Treasury Department should backstop Silicon Valley Bank. Thousands of companies will fold or lay people off next week because of lack of access to accounts through no fault of their own. Take the equity and fire the managers. But SVB's clients, many biotech, are important for national innovation and competitiveness. Plus, you need to instill trust and reduce financial contagion, panic, and further runs. So here you see Andrew Yang calling for a bailout of Silicon Valley Bank. Now, I'm going to tell you why a bailout is not going to happen. I think I read this tweet and I thought, how tone deaf is this guy? Because when you're talking about a bailout of a bank for California elites, you are asking poor people who are struggling in Ohio, poor people who are struggling in Alabama or West Virginia to give their money to bail out rich people in San Francisco? Are you kidding me? Like, people would revolt. I mean, people are still angry about the bank bailout in 2008. People are still angry about that. When the banks got bailed out and we all lost our homes, do you remember that? Like, ordinary people like you and me, we didn't get bailed out. The rich people on Wall Street got bailed out. And so people are just angry about that in general still, because that didn't happen that long ago. Now, you're going to ask all the people who are struggling across America to pay to bail out the rich people in San Francisco, who are still going to get most of their money back in 2 years. It's comes across as very tone deaf to me, and I think for all those reasons, bailouts are going to be a very difficult thing to sell. Now, you can see they've already tried to start to sell this as a thing that we should bail out these people. And, the rich people in Silicon Valley have a lot of a big voice in Washington, D.C. Like, these guys have an influence, but I just don't see it happening. I mean, this is such a hard pill to swallow. And I don't want to come across as callous to the situation of the people in Silicon Valley, because it's horrible. Most of these people, this is no fault of their own. Like he says, no fault of their own. They didn't see this coming. They're not involved in this. That was just their bank, and they woke up one day and their money is locked up for their business or whatever. It's a horrible, horrible situation. But just because your situation is unfair doesn't mean you have to unfairly take money from the rest of us to make your unfair situation fair and put your unfairness off on the rest of us. Like, that's not fair either. You can't make one unfair situation unfair for somebody else to make your situation better. Life is unfair. I hate to say that. Because I don't want to come off as callous, but life is unfair. And, everybody deals with stuff. And this just comes across as tone deaf to me, I think. The other thing you have to deal with is there was recently this train derailment in Ohio. There was this big train crisis still going on, environmental disaster for those poor people in that town in Ohio. No federal funds have yet gone to those people. So you're now asking you're still leaving all these people in Ohio helpless, but you want the federal government to give money to the rich people in California. I I don't see how this is politically viable. Like, people are not going to stand for this. Um, what are you guys saying? Liam's saying, how much do they pay to get the A1 rate? I remember getting a stimulus check. Amin says, taking assets by the government is not a state priority as it seems. Also, bailing out requires showing some good return on investment and EPS. Also, government doesn't like to cover others' mistakes. Also good points. So this is one guy who's already calling for a bailout of Silicon Valley Bank. I don't think it's going to happen. I think Silicon Valley Bank is done. But you should be looking for what is the next guy out there. There is someone else just this morning also went on a huge rant. Let me pull this one up. Okay, this is a guy named Bill Ackman. Do you guys know who this is? I know this is hard to read. I'm not going to even read this anyway. Bill Ackman is kind of a big, heavy hitter. It says CEO, Pershing Square. He's a heavy hitter on Wall Street, one of these like hedge fund manager type guys. He posted this huge rant on Twitter about the whole situation, and it basically just is doing the same argument Andrew Yang made, that the U.S. should step in over the weekend, backstop all of the all deposits in SVB so that nobody loses any money. But he does it in a very like frantic, the sky is falling kind of way, that if the government doesn't do this, it's going to spread to the rest of the economy and all banks across the United States are going to fail and all this other stuff. It sounds to me, just some advice, if you work in finance, don't do this. This guy looks like a fool for doing this. I read this and my thought was, it sure sounds like this guy has a lot of money in Silicon Valley Bank and is just very upset about it and is scared and doesn't know what he's going to do because his money is all locked up for the next 2 years. That's what it sounds like to me. And he's fretting about it on Twitter. What I think you have to do in any kind of financial crisis is stay calm, cool, and collected. Don't do this and go on Twitter on a yelling rant. That's not staying calm, cool, and collected. You have to keep your wits about you. I think, well, let's talk about how to deal with financial collapse, because I think this is kind of where I want to wrap up my thoughts here. So you have to remember that in general, financial collapse, I mean, even thinking about the Great Depression, a financial collapse happens by degree, okay? It's not like everything collapses everywhere across the economy. There'll be things collapsing here and there in different hot spots, all right? So your goal is to stay calm, cool, and collected and keep a clear mind so that you can navigate your way through the hot spots, because your goal is to stay standing at the end. So I'll give you an example. The stock market might drop by 25%. Maybe unemployment goes up from 4% to 10%. Okay, that would be, a really bad recession. All right, so you'd have to kind of navigate your way through that. Unemployment is not going to go to 100%. Okay, the stock market's probably not going to go to zero. It could, but probably not. Okay, we're talking about matters of degree here. So the goal is the things to do is the things that, we always talk about doing. Make good financial choices. Be conservative with your money. Protect your assets. And realize that most people are lazy and sloppy. Most people are not sitting here watching a live stream about SVB. Most people still don't even realize this is happening. So you have some time to get your house, your financial house in order. If you're one of these people who are vulnerable to having all of your money in one place, that if your bank gets into a glitch and you have to have time to work something out, then you have no other options. Just think about how do you make yourself stronger financially, and how do you protect yourself? Most people are not doing that. Okay? So all those people who are not doing that are the people who are going to get screwed. So you just want to be the person who is left standing off at the end and be able to work hard, do the right thing, and keep moving forward. And that's what you always have to do in business. Life is not fair. Bad things happen to everybody. Here, it was a bank collapse that nobody expected, but it could be anything. You could get in a car crash tomorrow. You could suddenly have a medical thing happen to you. You could suddenly go through a divorce completely unexpectedly, and it destroys your finances. Bad things, unexpected things will happen to you, and you just have to figure out how to make the best of your situation and keep moving forward. This isn't unlike any of those other situations. So those are my thoughts there. Let me catch up on some more of these chats. Jay Wagon says, is it fair to say SVB would not have been insolvent if not for the run on the bank? Granted, there were reasons for the run, but would the bank have had a chance to survive? I've heard this. People have pulled up past bank statements and said, look at the balance sheet. They're pretty much solvent. So why is there any issue here? You have to realize that those balance sheets, it's like they may be solvent in terms of assets and liabilities, but some of their, if they're holding a 30-year bond so that the bank is expecting, or a 30-year bank home loan or something, the bank is expecting to get payments over 30 years, and people might be asking for their money today. So that's the disconnect. It's like you can say, oh yeah, overall I'm solvent if you didn't ask for your money for 30 years. But, they're not, people are saying that, oh yeah, the bank is solvent. They're not solvent though. And all banks are like that. That's just the way banks function, is that if everybody asks for their money today, no bank can do it. And so that's just the question. Christian is in chat. Hey, Christian, welcome to the stream. Christian says, what are your thoughts on Canadian banks? I don't know any Canadian banks that well to know what the situation is in Canada. I would say, I'm just more familiar with the U.S. situation. And I would say in the United States that the big driver of everything, we started the stream with this, is that on the macro level, it's all driven by the Fed funds rate for the last 10 years being at near 0%. And then suddenly jumping up to 5%. That is the driver of everything, because everybody's portfolios are loaded up on 0% interest rate debt. Everybody's loaded up on debt. It's mostly not consumers. It's mostly businesses that have this problem. It's mostly businesses that are heavily funded by debt. So that's kind of what's driving it. I think it's a big problem in the United States. Christian is saying, I wonder if this could become an international issue. I think it is affecting international, because the U.S. Treasury rates have a really big impact internationally, especially over the last 10 years. So yeah, I think it probably is international. I'm not as familiar with banking in other countries. Amin says, I would say Canadian banks are really well tooled to hedge their risks. Also, Bank of Canada is a real dog watch. All right. Well, that's going to be it for the stream today. Thank you guys so much for being here. I'll be back with another 10-minute video next weekend. I usually post a video every Sunday. If more shocking news stories develop like this, I'll try to do another live stream to do the same thing, kind of talk through it, talk about my opinions on the future and everything like that. Yeah, let me know in chat. And if you're watching this after the fact, leave a comment. And don't forget, if you're enjoying the stream, to hit that like button. Subscribe if you're new. And I'll see you in the next video. So thank you, everybody in chat. Thank you, J-Wagon. Thank you, Amin. Thank you, Hair Director. Thank you, Christian. Thank you, Liam. Thank you, everybody who stopped by the stream today. Everybody have a great weekend. Try not to stress out too much, and enjoy the finer things in life. If you want to just hang out more, I do have a gaming channel I stream every single day on. So if you want to just hang out and chat, that is also on YouTube. It's called Zach Daily Games. I'll be there tomorrow night talking about City Skylines 2, which is a new game that is coming out soon. Oh, Kevin's in chat saying these interest rate hikes can eat a business alive quite quickly due to the debt service capabilities, even those which are profitable. Very good point. And with that, we're going to end the stream off. Thank you again, and have a great weekend.